All right. All right. We are live. It is September 29th. Oh my goodness. September is almost gone. It is another beautiful day in paradise. The weather is looking charming. It's football season. The cherries are about to blossom in DC. My favorite time of the year to live in Texas. We have a fantastic show today. But before we get rolling, let's get some mood from our only and incredible musician, Dr. John Sibley Butler. John?
Uh-oh.
Oh,
He's
thank
frozen.
you, sir. Whiskey River, take my mind. Don't let a memory torture me. Whiskey River, don't run dry. You're all I got, take care of me.
very nice.
Good afternoon,
very
Andreas. How are you doing today?
Nice. How are you doing today, John?
That was for Gabriel. When I said whiskey, well, it was a great day. I had my
too early for whiskey.
I had my MBA class this morning. We talked about wealth creation and ecosystems and energy and creating the new Austin, Texas. It's a wonderful day in Austin, Texas. We've had some rain come back to us. There's a lot going on politically. There's a lot going on economically. There's a lot going on around. So it's a good day to be around and to enjoy all of the excitement.
Absolutely, absolutely. Llewelyn, how are you, sir?
I'm very well, sir. I'm very well indeed. Thank you so much. I'm looking forward to our discussion today. I can see that Johnny is loaded for bear and that he thinks I am a bear, which is an unfortunate situation for himself because I have remarkable ways of fighting back.
So Gabriel, I want to thank you for being with us today. How are you today?
Yeah, I'm good. Thanks for asking. And it's great to see all three of you. I mean, we had a pretty good time last month, the Digital 360 conference. So good to see you all again.
Absolutely. And remember, Gabriel, that these two gentlemen here are two lovely friends, but somehow they get at each other and start quarreling. So don't worry, don't get caught in the middle of this.
Okay, I'll try to stay out of the crossfires.
So before we get rolling, I want to introduce you for the audience formally. Sure. So Gabriel Reyna is a managing partner at Bandera Capital. Bandera Capital is a company that believes in people first. So they generally look for owners and founders that are smart, passionate, and want to go on a growth journey. Gabriel is on the industry advisory board of many things, including Texas State University CIEDAR Consortium, which I happen to run. He's also a board member at the Canon Energy, an executive advisor to 5B, investor in C-Forest, board member at Duality Health, a non-executive director at Tulu, advisory board member at Atlas Engineering Group, and an investor in Keiretsu Forum. I'm happy to say that Gabriel is a Bobcat. Yay! He has a Bachelor's of Science in Manufacturing Engineering, and he has had some graduate executive courses and classes taken at RMIT University and the New York Institute of Finance. Welcome, Gabriel.
Thanks for that, Andres. Nice to be here.
Absolutely. We're glad to have you. And I'm going to go quickly here as our audience shows up, and we do have an audience. And I'm gonna share my screen with everybody, and I'm gonna show you what we're doing. So we are going live with our videos on Digital 360, and I wanted to give you a snapshot of our keynote address on smart cities from Noel Bernal, the city manager at Brownsville, Texas. And here's a quick teaser of his video.
So we have to do more with less. We're beginning to do stuff on the green energy side. We're beginning to create our own grid system. We own our own electric system, which is what's going to help us with the middle mile, but we're also doing other things on the energy side to make us more sustainable for the long haul. And the growth is coming, and the growth is coming. So I challenge him, what do you mean by growth? What kind of growth? How fast are we going to grow? What's the rate of growth that we're going to be experiencing? Have we set up the systems in place to support the growth? On and on and on. Those are the challenges. At the same time, those are the opportunities.
And you probably know that we just finished Digital 360 and we just issue our trailer video for that, and here goes. So anyway, I want to just remind you all that we're very excited about what's coming. Digital 360 2022 is in big discussions right now on how we're going to go about it. Too early to tell you exactly what's going to happen, but we're very excited about it. And anyway, just wanted to start with that. Lots of stuff going on, and actually, you know, I'm curious, since we're going to focus really on innovation, entrepreneurship, and wealth creation. Johnny, tell us real quick what's going on. You know, we seem to be, the stock market is up and it's down, it's sideways. The Feds are trying to figure out when they're going to stop sending more checks on the COVID thing. COVID things to be, you know, a little spiking here and there, but nothing crazy, even though there are football games going on with 100,000 people in the stadiums. The economy seems to be doing fairly well. The price of oil is now 74, 78, is almost looking like peaking oil may happen here in the next 90 days or maybe 6 months, which is not a good thing. But tell us, where are we at, Johnny? What do you think?
Well, you know, we have lots of innovation, but at the very, very tip of the innovation is all of the stuff that's coming out of Washington, D.C. All of the facilities to redo America, the multi-trillion-dollar money that we enter the America to improve all of the construction from bridges and et cetera. So it's a very interesting time. Because what we do know is that we have a traditional economy that would be infused with all of this money. So I think in terms of the stock market, it's kind of biding its time. As the data goes in, it is, quote, making decisions about the future. We will have inflation. If we're going to do construction with a whole lot of infrastructure, what does that mean for the cost of concrete? What does it mean for the cost of wood? What does it mean when we redo all of those, you know, everything in terms of the infrastructure in America? So you can see how people are always thinking about the future. And our predictive algorithms that we have, it cannot predict all the infusion of the cash that will go into the American economy when this bill is passed. So we have the traditional kinds of enterprises. We had all of this innovation that was happening during the pandemic. We have new firms coming on board. The stock market, of course, you expect it to be up and down, but the big question is the job indicators. And what we know is that we have increased the number of jobs, not back to where we were, but certainly job growth is certainly there. So if we think about the stock market itself, then we say, what happens when all of a sudden, if you look at America as a collection of enterprises, when trillions upon trillions of dollars are infused in that economy? You know, on Andreas, on the virus, I think that if you look at the numbers here in Austin, I think we're down to about 50 people a day. I think we have beds in the hospital. These are good indications that we like to use. We still have the no-sayers, the none-sayers, the people who don't want to take their shots. And what the science says is that, hey, you might get sick if you have a shot, but there's a great probability that you might survive it. And then if you look at what else is happening, there's a lot of mobility. My distinguished colleague, Llewelyn King, had a great article on being an entrepreneur versus the gig economy, someone that's hanging out there by themselves, really getting it done. So one of the things that the pandemic has done, but it has infused the idea that you have an alternative way of doing things. You have an alternative way. The other thing that's happening in my world is in Austin, Texas, venture capital and wealthy people are moving here in numbers. And I'm sort of one of those who entertain them and talk about the opportunities that might be in Washington. I'm shocked that Gabriel hadn't called me. I'm just knocked off my feet that he hadn't called me if he's in this. I mean, you know, I'm just knocked off my feet. I mean, I wake up in the morning, where is Gabriel Reyna? I mean, here we're doing in Austin, Texas, we're sitting on the world on fire. People are investing in companies. People are creating wealth, millions and billions of dollars, and Gabriel's sitting in his office scratching his head. So I'm just wondering why he has not called me. And the last thing I think is the hope for the future. All of a sudden, I think we do see a hope for the future. And of course, finally, underneath all of this is what's happening across the world with the conflict. As a decorated veteran of Vietnam myself, I understand what people are going through. So it's an interesting world, but we must always concentrate on the future.
Yeah, let me go to Llewelyn, and we'll come back to Gabriel to give us his take on what's happening, and we'll get deep into capitalism and entrepreneurship. But Llewelyn, where are we at? I think that have we turned the corner yet? Have we turned the corner?
We are at a precarious point, and the big news, which I don't think was in your list, is that Europe is in the grip of an energy crisis that has international ramifications. It's already reached into China, where production is being curtailed because of a shortage of natural gas to make electricity. The cost of natural gas in Europe has gone to hundreds of times its normal price, which means that poor people in Europe will be freezing this winter. Particularly affected by the crisis is the United Kingdom, which has had a double whammy. It's at the end of the Russian pipeline, as it were, for natural gas, but it also is more reliant on wind power than any other, 20% for its electricity. The result is that when we had a wind drought, where there was a wind drought, the North Sea, famous for its gales, famous for the wind. Every island is described as wind blown, wind this, wind that, the windy area of the world. There has been 6 weeks without adequate wind and a shortage of sun as well. This, combined with a shortage of natural gas and high natural gas prices, is having a shattering effect, which will reach us very shortly as the globe is interconnected, and it's particularly interconnected with natural gas. The winners are, of course, the big gas-producing countries like Qatar. To some extent, we will benefit if we're able to produce the gas and export it, and we don't have people closing down our gas lines, which they're trying very hard to do. We are in a better position. Even Brazil is affected. So to think the world economy is good, it also is hugely inflationary. Energy costs are inflationary. The price of Brent crude reached $80 a barrel yesterday, which is as high as it's been in decades almost. This is very big news. This is going to impact all of us. And we can't, there also are other difficulties. Are we destabilizing our own electric supply system by underemphasizing gas and overemphasizing interruptible supply from wind and gas? And you've got some stunning growth in Texas. I was made a television program yesterday, and one of the guests on it was the president of Rayburn Electric outside of Dallas. He has one member who is growing at 5%, and another one who's growing at 10%, and they have a unique difficulty. They're not sure of future supplies because so many large data companies are moving into their area and writing very good contracts for electric supply for data mining, etc. So it's not exactly a predictable world. The European energy crisis is substantial and it has huge ramifications. Even Brazil is suffering from it. So I would look to, if you want to invest, look for LNG producers and suppliers. If you want to go to Europe for your vacation, take your warm undies. You will need them.
Hey, Gabriel, give us the perspective that you are our first venture capital guest. So clearly, you know, when I hear half empty, half full, when I hear one side of the coin, there's the other side of the coin. What does a venture capitalist think of all this madness that is going on? And do we have any opportunities to be looking forward to?
Yeah, no, absolutely. I think, look, there's a lot of opportunity. I think, you know, some of the stuff that John, you mentioned, and Llewelyn as well. I mean, there's a lot of big kind of structural forces at play when we look across the globe. And, you know, we talked a little bit about things happening here and happening in the UK. You know, part of our firm and a big part of what we do is in Australia. So we've got a bit of a, you know, I've got a kind of a view on things over there. And I mean, I think one of the things you didn't mention was, you know, the nuclear sub deal that the US and Australia are doing and kind of what that means for geopolitical movements, you know, on that side of the globe and positioning with China, et cetera. But yeah, I think, you know, those things are happening. I think, again, a slight view in Australia, again, where I have a lot of, you know, interests is Australia is kind of waking up to this reality that, you know, for many, many years as a big part of their GDP is resource exports, right? So steel, iron ore, you know, big kind of mining, you know, industry type things. Now, you know, they're really looking, you know, kind of to reset and rebalance that and looking at, you know, things like energy. You've got a massive project up there. I don't know if you guys are looking at a project called Sun Cable, where they're doing a 14 gigawatt, you know, solar farm, underwater cable to Singapore to sell, you know, renewable energy into Asia, really, right? And this is becoming more and more of a theme. Same thing with agriculture. So I think as we shift towards, you know, things like decarbonization, electrification, look at what's happening geopolitically in that part of the world, you know, these are some real significant shifts that are happening. When we look at what's happening, I think a little bit more closer to home, John, you mentioned the stock market. I mean, it's no secret the last, you know, really kind of 12, 18 months, you know, tech stocks in particular are really, really frothy and somewhat overpriced, overvalued. You know, on the flip side, you know, things, the treasury yields are up. You know, industrials and those stocks are, I think, doing quite well with underlying commodity prices kind of, you know, staying pretty high. And then, I mean, Llewelyn, to your point, the gas prices, you know, I guess in a more short-term sense, we've had, you know, Hurricane Ida come, you know, those big storms typically kind of take some of those facilities offline in the South, you know, those inventories kind of go down, margins go up, and we see those prices come up. So again, I think there's some short-term seasonality things that are typical, but on a broader scale, you know, this gas shortage in the UK, this geopolitical situation in Australia, what's happening now in the markets, and this kind of, you know, this waiting period that we're in as a country here in the US on the back of what's happening in Washington this week and the shutdown really going into the weekend. Big structural changes across the globe, and of course, where there's anarchy and confusion, there's opportunity, right? And so, from a venture capital perspective, from a private equity perspective, I think all these shifts and these forces naturally, you know, we look back in history, they create opportunities for new business models. You know, some businesses are not going to survive some of these things. I mean, I think part of the news bulletin that you sent out was a lot of these companies, the data is coming out, a lot of these companies that shut down during COVID or due to COVID and the pandemic are really kind of shut down for good. But equally, there's a lot of new companies and new business models kind of spurring out of that, right? And so I think, you know, across the board, Of course, we have our strategy and our themes that we're investing in. I think we're looking at, sticking with those themes, and cutting across those themes. How are these structural forces and changes creating more opportunities or creating opportunities to accelerate things that we're already investing in? So I think there's a lot of opportunity.
Yeah. Go ahead, guys.
Let me ask you this question. If you look at the structure of venture capital, if you look at America, for example, and I do understand what's going on in Australia and Canada, Laura Kilcrease is in Canada doing great things. In America here, most of our VC investment was in California. I mean, Northern California, not necessarily Southern California. And of course, in Austin, we kind of started companies with angel networks, that is wealthy people. Dell was angel, Whole Foods was angel, National Instruments was angel. Do you see the movement of venture capital, not just to Australia, but to other places, going outside now of Northern California? We have tried to keep the investment eco-structure real dynamic here in the Austin region. And by that, I mean Austin, San Antonio, Dallas, we call it the Austin region. So how do you view the movement of venture capital now? Because our angel networks here, we have organized all of the wealth. We have the Central Texas Angel Network, the Baylor Angel Networks, the Houston Angel Network. And if you look at investment, they do probably 3 times or 4 times the amount of deals that a VC would do. So how do you see VC in the future for Central Texas, as opposed to everything being in Silicon Valley?
Yeah, I think we've been investing in across Australia and the US, and that's part of a kind of strategy that we have. But in the early days, something that informed that was the concentration of the big VCs and what's happened, what's traditionally been growing and developing in the Silicon Valley, right? And the reality is that it's always going to remain a big power player in the space. But I think as those funds get bigger and bigger, there's a certain kind of subset of investments that are going to do well, and cycles in the companies and maturity levels that they need to have really to write those big checks and things like that, right? So I do see just living and operating in Australia for a number of years and coming back into the US, I would say over the last really kind of 5-10 years, I do see a lot of US investors where it's quite competitive here, and I'm talking about the VCs, the more institutional kind of VCs, where it's competitive. There's a lot of capital out there that is now going into these alternative assets. VC is a big one, and it's quite competitive here in the US. So to find value, I see over the last 5-6 years a lot more US firms looking that traditionally had these really kind of blinders. We only do West Coast, or we only do Southern California, or they're really kind of getting outside of their geographical kind of comfort zones, and that extends to outside of the US. I see a lot of US investors coming over to Australia, coming to the UK, on a regular basis now, and looking for opportunities. So I think I see that as a trend that's been happening and will continue to happen. In terms of the angels, but I think I see a trend that's happening now, and it kind of started maybe 2-3 years ago in terms of what I can see and things that I'm intimately involved with, is just a much broader trend about democratizing access to venture capital investments for the retail investor, right? And so somewhere in the middle between traditional mom and pop retail and VC are your kind of angels, slightly more sophisticated, a bit more capital. I mean, the mere fact that they're involved with an angel network says they went looking for that. And but I think more broadly, I see this effort, and there's a few companies and platforms that are really working on, providing access to venture capital as an asset class to retail investors. So I think that's a trend that I see really kind of ticking up. I think we're going to see a big kind of uptick in that. In terms of Central Texas and the angel networks here, I mean, one of the angel networks I'm pretty involved with is Keiretsu Forum. And to your point, I mean, you look at kind of the PitchBook league tables. I mean, Keiretsu Forum as a network does more deals. I think they're number 3 on the league table in 2020 for capital placed and number of deals, right? And so absolutely, these angel groups are doing a lot. I think they play a very important role in that early stage, kind of space. And so I think certainly in Austin, Houston, now we're seeing in that, more in that kind of energy space, but there's also fintech and things coming out of Houston. You mentioned Dallas, San Antonio. I think outside of Silicon Valley, New York, Miami is another big hotspot, but some of these more kind of tier 2 cities, I wouldn't consider necessarily Austin a tier 2 city, but again, in comparison to Silicon Valley, we're in that early stages of critical mass as a venture and startup ecosystem. And I think something that comes along with that is naturally there's a lot of early stage companies, right? If that capital stack isn't there for the Series B, Series C, Series D kind of things like it is in Silicon Valley, we're naturally going to see a lot more of that deal flow in the early stages, right? And so those angel networks play a really big role in those early stages. And so I think, I do see a lot more, I think last year we had some really good exits on the public market. So a lot of, companies going the IPO or the SPAC route. I mean, that mints a lot of new millionaires in that tech space, people who've been around tech, maybe, employee 1, employee 100, whatever that may be. They know at least, to some extent how things work. And one of the first things they do with that capital is they want to go and start investing. They kind of lived and breathed that space and they want to go do that. And one way to do that and get access to deal flow is to join these angel networks. So I see a lot of that happening and that trending up as more of these, IPOs and kind of SPAC exits kind of happen. The other interesting thing I would say is, there is, part of this kind of tax deal that's happening out in DC is, some of these incentives around capital gains and as it relates to kind of QSBS and what VC will be able to continue to retain as part of that is something that I think everyone in the VC community kind of has their ear to the floor on. I think we don't know where that's going to land, but there is a world where that maybe goes negative for venture capital, but remains as a positive for the individual investor. And I think that could see the angel networks playing an even bigger role in that space and a lot more happening there if that happens. So again, some of the things that I'm seeing.
Yeah, you're right in the sense that if I invest in something and I'm an angel myself and it done well, I want to be able to write it off. We got those kind of things that we have changed. Okay, thank you.
Llewelyn?
I have a question, but I'd like to preface it with a little piece of information, and that is we do look a little bit too much perhaps at electromagnetic things and not enough at new materials, which are now, in my view, going to be the future makers, particularly at the moment graphene, which is a single layer of carbon atoms, usually derived from graphite, but which is very difficult and expensive to produce. But there are thousands of university laboratories working on it. There are a huge number of patents in the thousands that have been filed. And now 2 breakthroughs that I can report on. One is that in the north of England, they are using graphene in a test on roadways to see if they can last years instead of the usual couple of years. And particularly as a starter, the markings on roadways, which wear out always within about 18 months, the stripes painted on the tarmac. The other thing, which I think is going great guns and doesn't get sufficient attention and will one day incorporate graphene, and that is additive manufacturing, 3D printing. We are now seeing whole houses printed from very large printing units. This is a major development because it may bring down the cost of new housing. And going back to graphene, Samsung is talking about a graphene phone where the battery will have 12 times the life of current batteries in cell phones. These are big. They're only at the beginning, but these are big developments. When it comes to Australia, Australia is a large exporter of natural gas. So in one way, it's in a very good position. In the other, it's got huge tensions with China, which make life very difficult. I would like to ask you, Gabriel, and I found what you said totally fascinating, really interesting. Traditionally, VCs invested in a company, grew it, or watched it grow, and then there was an IPO, people got their money out, and that was the game. And we had a brand new player on this corner. Now it tends to be that VCs ask their the companies they're going, the startups that they want to sponsor, whether they have a potential buyer at the end of the game, whether Google or Amazon or one of the big players will buy them. And I think that is very unfortunate, because that increases the size of Google, the size of Amazon, the size of Facebook, but it doesn't actually increase the dynamic in the marketplace of new ideas, new products, and competitive pricing. It enhances large, semi-natural monopolies into permanent, almost irremovable monopolies, unless you took antitrust action against them, which nobody wants to do. So what is the VC plan? Is it to have, at the end of the day, new companies on the block, or at the end of the day, to fatten up a startup and sell it to an even fatter organization?
Well, if I'm the startup, I want it sold to a fatter organization. God bless America.
Yeah, look, I think, John makes a good point. I think under that comment is, where's the money at, and where are the where are the incentives there, and where are the intent, for the VCs, for the LPs and the underlying startups. I think at the end of the day, we've got to make money, and so I think it's going to be a different answer depending on what kind of what VC you ask and the way they answer that question. Certainly from where I'm sitting, I think that there's a couple of things that there's some trends out there that we can look at, and they're driven by the behaviors of the VCs and the PE groups, right? And one of those trends is companies remaining private longer, right? And so I think that the IPO, with these kind of frothy valuations, this kind of level of uncertainty currently across the globe in the markets. If you were on the market 18 months ago, that's a great thing. I think, right now you got to have a really strong strategy if you're going to go and do that. And so I think we're seeing a trend towards more companies staying private. Now, these are VC-backed companies, right? And so the VCs have a lot of influence on, whether they stay public or whether whether they stay private or go public. And so I think, why are VCs doing that? And I think that, we are going into this new paradigm, not just in terms of the exit strategies for VCs, but also just the value creation for VCs. I mean, one thing we haven't talked about, but I feel strongly about, and maybe it's a topic for another discussion, is, this kind of 10-year close-ended model on the VC, model, that kind of 10+2, given the level of uncertainty and how fast things change, in the world right now. I mean, is that really the model suited for the right types of behaviors, right? It's kind of like spend the money for the first 3 years and nurture, and then, farm, and then kind of sell on the back end. I think at one point in time that made a lot of sense, and the markets, the IPO markets as an exit, made sense. And some of these big conglomerates, the Amazons, the Googles, kind of being hyper acquisitive, it still today makes some sense. But again, I think we're seeing a shift, and some of those trends are we can look at and identify, like companies staying, private longer. I think another thing we're seeing is private equity starting to kind of come down, down into venture capital. And I see a lot of, private equity guys really kind of trying to play the VC game, and, some of them are doing it well. And I think where I see it being done well is, to your point on the exit side, is they're saying, well, hold on a second, let's not sell this to Google or Amazon. This is an interesting platform play, right? So now let's start to build on that platform and start to, do some kind of platform building on an interesting company. So I think, companies staying private longer, PE kind of now, dipping its toe into VC. I think at some point this will be a common discussion around the actual VC model, that 10-year model, and whether that really makes sense right now. And so I think, these things are happening. And to me, that's all driven by the behaviors of the VCs, the GPs and the LPs. And so I think, I'm not sure if I'm answering your question correctly, but I think that, we are seeing a change. It's not very clear cut and kind of where that's going to end up, but I think we're seeing a transition to a new paradigm here.
I want to jump in, Johnny, and elaborate a little bit more and get Gabriel's sense because of that multi-continent view that he has, which is very unique. So to belabor more the point that you're making in the question, so clearly, the SPAC business model is a new answer to monetization faster, right? And I think the SPACs are probably, I would say, will you agree they're successful, right? They're successful. SPACs are successful.
They're being successful in most instances, I think, for now. I mean, it's really been something that's taken off in the last 18, 24 months.
Yeah.
It's been around forever. But
I think the SPACs are gonna refine, and there may be different models of SPACs, right? The other thing that we haven't talked about that I find fascinating, you probably know that one of the key persons in Shark Tank, right, Mr. Wonderful, now promotes something called Star Engine, which is like Kickstarter, right? And so this whole notion of going to the non-institutional, but the angel, and even the non-qualified, investor to raise funding, right? So it's really interesting how the business model. The other thing, and I'm curious to your comments on this too as well, is I see now, a lot of people, CMG does strategic planning to help companies with digitalization, decentralization, and decarbonization. And I see a lot of players that used to be, we're a construction company, we're an energy company, we're whatever. And now they're all morphing into other things, right? So for example, is Amazon really a retail company, or are they a software platform company, or are they a logistics company, or are they an e-commerce company, or are they a bank? Right? I mean, all of a sudden, all these companies are dabbling into all kinds of things. So I see the private sector, like the Koch brothers and the Bechtels of the world, and all these family fortunes, and they're becoming the new Google, the new Amazon of acquiring technology. They're in the middle of buying everything you can possibly imagine. What are your thoughts on that, on the acceleration of capital creation and the VC role in that?
Yeah, I think that look, something that's kind of cuts across all of that is just the amount, the amount of capital that is out there at the moment looking for a home, as we say, right? And so I think, venture and venture capital, private equity, that those are asset classes that are consistently kind of outperforming the index. With the market the way that it is at the moment, it's kind of really bullish kind of position over the last 18 months. I think that's an area that, as more wealth is being created, it's being funneled into this kind of VC and private equity space. And at the end of the day, it's this kind of the old saying, the golden rule, right? He who has the gold makes the rule kind of thing, right? And so I think inevitably wherever that capital sits, it's going to play a role. I mean, all these things we talk about, whether it's the acquisitions or the companies going on a big growth journey, they all need to be funded and they all need to be capitalized. And I think that the amount of capital sitting in that kind of venture capital and private equity space is huge today, right? And so I think inevitably they're going to be big. They're going to play a huge role in that. I think to your point, you mentioned some families there, right? I think there's a lot of big now kind of family office that are these dynasties that are built on the back of a successful business, that one of the generations built, and now the new generation, they're not too keen on that old style of business, let's say, whether you're a building company or whatever, right? And so I think there's also this element of generational wealth transfer. And alongside what are essentially some very smart intellectual people that are now kind of have the reins and have some options here. So they got all this capital, they got all this, and they're looking at the world around them. Again, all these structural changes. I think there's a lot more focus on things like decarbonization and net zero and the sustainable development goals. Certainly in that newer generation. And so I think a lot of that those acquisitions, a lot of that next phase of generational, dynasty building is going to be more aligned to those spaces and that. And so I think that's something that's really, again, that capital, that generational wealth transfer, that's going to play a huge role in that.
Now, let me see if I can sum this up. I think if you look at VCs, they have taken the risk out of a lot of what they do by letting the angel networks and the private equity do most of the background information. The great thing that has happened is that if you look at the chain of investment, what we used to call Series A, or on people where there's not institutional investing. So if you just look at the numbers, so yes, angel networks will invest 4 times as amount as VCs. They take maybe 1 out of 100. But they're also reducing the risk in the value chain. So what's happened is, as private equity has evolved into the market, they have taken the risk out of a lot for the VCs. So the VCs are more down on the chain in terms of the reduction of the risk. So you can say that companies are being incubated by private equity. They're being incubated, by angel networks. But when it comes to the big money, from the numbers point of view, VCs will loan between 500,000. Angels will invest between 500,000 and 1.2 million. Sometimes they combine together to do 2.5 million. Private equity is interested in purchasing the company if it has value already, and then taking the value out. So I think if you look at what's happening with VCs, angel networks are doing the due diligence. And those who are well, then VCs are continuing to fund them as they go from smaller angel networks to institutional investing.
Yeah, I'd like to come back to this issue of what is the destination of the startup. I think it's very important. Remember, at one time, Microsoft and Google, etc., were startups, and therefore we could buy into them, and they were good for the nation while they were in that mode. Now they're in this mode of acquiring everything, and yet historically we don't see big innovation coming out of big companies. Some innovation does, but the breakneck invention just doesn't happen. I mean, we have a problem in aviation where we have actually in the world we have 2 airframe manufacturers for large jets. That cannot be good. I'm sure that we would have better airplanes if we still had 4 airframe manufacturers. If we still had McDonnell Douglas and Boeing plus the other 2, we've lost something in allowing these consolidations. Now in high tech, we are encouraging consolidations because we have set up a de facto path to success for the startup that it's sold, but afterwards it's probably going to die or exist in a not very fertile environment because big companies can only be so fertile to so many projects. The history is not good of conglomerates, and I'm not sure that this is a good thing for the nation or for technology. I'm not sure we're going to see the technological evolution that we've seen in this marvelous, exciting, tremendous period of the dot-coms. I'm not sure we're going to see that when the dot-coms are 3 large companies. It is something that we should be concerned with if we're interested in innovation, if we're interested in the nation, and if we're interested in avoiding all of the problems which come with monopolies.
Well, let me just say this. A lot of what you call big companies don't exist anymore. So a lot of these startups are now the big companies. So when I came out of college—
that's the thing, that up to this point in time, that has been true. But
Right.
The new dynamic is not making that possible, that replication will continue.
Well, I think what you're saying is the startups are doing the science and they're being purchased by the larger companies. And I think that will continue to happen. So Louis, if you look back in the history, at one time, Ford Motor Company did all of their internal research. Now they have, and they also train all of their engineers. Now all of it is outsourced to universities, right? So very few companies have their own scientific laboratories. So they depend upon Gabriel to fund those great companies that they find to become technology companies. So I think it's a dynamic price, and I think it has always been happening. So what we call a monopoly at one time with 3 people, whether it's Microsoft—
Let me give you 2 examples which contradict your otherwise splendid thesis. Bell Labs, AT&T had the most inventive laboratory in the world, but they didn't do anything with it. And likewise with Xerox and their computer factory or research lab, I forget what it was called now, out on the West Coast. Big companies don't know how to take advantage of things within their own organization. It is just beyond them. And I've talked to many CEOs down through the years about this, from Westinghouse to General Dynamics to GE. I used to be friendly with the chairman of GE years back. And they all agreed with me that innovation was extremely difficult. They all talked about it. But if a young engineer in a large company comes up with an idea, it then has to go through so many hoops and, oh my goodness, it's not going to happen. It is almost certainly not going to find and be tested in the marketplace. The marketplace cannot be predicted. Big companies tend to want to predict. And if they're making money, if they become rent takers, which they are, there's less inclination to go forward. And you get a stultifying effect. We saw this in the UK, which was once this enormous dynamo of invention, the epicenter of the Industrial Revolution. But the companies developed sclerosis. And it's going to happen to us here in the dot-com world, particularly if we allow them to essentially snuffle out new technology.
Well, it might not. I gotta switch topics here because I'm looking at the clock, and Gabriel, we're interested in understanding what is the Bandera formula for investing. Are you investing in technology? Are you investing in a patent? Are you investing in the management team? Are you investing in the bravado of the founder? What's the formula?
Yeah, look, I think, it's a tough question to answer. I think like what we're doing at the moment, and this has been an evolution, and we're reacting to kind of what's happening and responding to what's kind of happening, in and around us, right? Again, a lot of capital, generally, at a macro level, there's a lot of capital going on. There's a lot of big VCs. We're not a big VC that's doing 1,000 deals a year and hoping one returns the fund. So I think, first and foremost, we're kind of more of that quality over quantity. We do, take a bit more, I spent a few years in private equity. And so we do tend to take a bit more of that playbook and try to bring it into this space and really try to nurture those companies through certain periods of growth and that kind of chasm where we think we can add value. And that's been successful, is being more hands-on. So, we're looking for, first and foremost, for companies that will do well in that environment where it's really quality, it's very hands-on. I think, again, with all that kind of capital and competition really in our space is what we've tried to do is not be so, focused on one particular business model. And so we're really looking at technology agnostic, business model agnostic, and then really just focusing on our lanes in terms of the verticals that we invest in. So energy, food and agriculture, logistics and mobility. I mean, that's really, and healthcare. So that's really kind of where we want to play. Yeah. And yeah, I think that one of the things that we're looking at as well, and we've done this now, is we in the beginning, we said, look, we don't really want to take that product risk. We want a product that's in market or has some traction, has some revenue, and really help them through that early growth phase, do some things around commercialization and team building and things like that. As the market has become more competitive, we again, like private equity now playing in venture now, and you're seeing this, and we're doing as well, is now venture playing a little bit early. And so we're definitely looking now and building more conviction and comfort in looking at companies and founders that are early on. And so rather than talk about that product market fit, now we're in this world of this kind of founder market fit. And that's something that we're very much on when we're investing in something early stage, where there's an idea or there's half a product and they're kind of really still in that early stages, is, really building conviction in that team and looking at that kind of founder market fit. And that's something that, founder market fit, I think you mentioned it, it's something you pulled off our website, but we're looking for, people who want to grow on a growth journey, and going on a growth journey with an investor who's pretty active means you have to be coachable. You have to be open to new ideas and really be this kind of lifelong learner, right? Yeah. Know intensely what your industry is, and then and then the ability to kind of leverage our firm and others who we bring into the fold to kind of take those next steps. So that's, you know, at the granular level, that's our kind of playbook and where we like to
go. So real quick, when you look at investments, and there's a supply chain for investments, right? So let's talk you know, football for a moment. So the kids go to Pop Warner football, and eventually they go to middle school, and then they go to the high school, and then they go to college, and then they go to the NFL, and there's all kinds of, you know, add-ons in terms of performance coaching and to supplement all that. So the VCs, you know, the angels are in that Pop Warner stage, and the VCs are kind of an elongated stage. And where do you see the pipelines and the places where to find the pipelines? Are they more you know, pervasive now than 20 years ago, than 10 years ago? Is it difficult still to have the right pipeline, the quality of the deals? I mean, you would think the digitalization and how easy it is to build a PowerPoint and assemble a team and go to a WeWork, that, you know, there should be 100 times more startups with more ideas and greater quality. Is that true or not?
Yeah, look, I think in terms of building deal flow and building that, you know, in our world, what we like to call proprietary deal flow, some unique mix of where you're finding deals, right? I think you're right. Digitization, you know, and what we've seen in the last 24 months, right, with the pandemic and with COVID is, you know, we've had to learn how to do more online and do more digitally, you know, making investments where we may not meet someone face to face, and that's something that, you know, I think across the industry is you know, getting comfortable with. But that's all enabled by these digital means and things like that. And so I think there is that element, but at the end of the day, we you know, at least from my view, and this is my 2 cents, is that it's still a people business, right? Again, I talk about that founder market fit, really investing in people, investing in the team early on. And so I think, you know, yes, you can use those tools, and we certainly use those tools and those networks and ecosystems to find deals. But what I'm finding is that a lot of the best deals we do, a lot of the best investments we make are founders who have really kind of found us, or we found them through some, you know, the same old kind of pathway as a referral. And I know that the founders don't like to hear this because it's a hard thing to do, but at the end of the day, when those referral networks are there and that chemistry is there, and you can kind of really, you know, leapfrog a lot of that early stuff and really get into the meat of talking about things, I think that goes a long way to build that trust and do that. But I also think that, you know, and it just kind of touches on Llewelyn's point around, you know, that whole exit strategy for a startup, and what's that playbook now, right? I mean, one of the things that I was going to add there, I think it's relevant to this topic now, is that, you know, and I'm simplifying this very much, but I think one of the things that I'm kind of keeping tabs on, don't necessarily have a database, but I'm just, you know, in mental model as I go, is I'm seeing like really 2 types of founders out there, and I'm simplifying this, but there's a founder who, you know, really, you know, wants to, I mean, their goal is, I want $1 billion company. And they may be experts in their field, and they're really smart, and they got the team and the product, and on paper, it's a great investment, but their drive is $1 billion company. On the other side, there are founders who, if I get rich, I get rich. I want to change the world. I want to solve this problem. I want to do better for humanity. And I think that there's just something about, you know, this whole kind of, you know, passion around solving the problem or working in that space, or, you know, service of others kind of thing, that really, you know, speaks a lot. And I think if you look across our database, the successful kind of portfolio companies are more on this side of the spectrum. And again, so I think, you know, yes, we're using all those tools, we're building ecosystems and partnerships, but we're doing that to create more referrals. So the best thing I think for us that we can do, and again, I'm speaking for our business, is create those connections, use those platforms, but use them to the extent where there's still a human connection there. You know, if there's somebody making a referral, they know who I am, they know who my partners are, they know who we are and who we stand for. And that chemistry and that referral network is really what we think is doing the good work, you know?
Yeah. Any follow-ups?
Was interesting.
I have
I'm sorry. What's interesting,
I
brother,
have sorry, beg your pardon, John. I have a follow-up. And do you have a vertical on new materials? I think materials are going to be so important in the future, whether it's new materials for batteries, new materials for everything. We've got to take the carbon content out of a lot of buildings, out of everything, and that means new materials. And obviously fortunes are going to be made, and giant new entities are going to emerge that master these new materials. Do you look at that as an investment possibility?
Yeah, it's an interesting question that you have, and I think it's something that, you know, we've over the last 2-3 years of investing in things like energy, so solar and looking at solar cells and that kind of thing, looking at the built environment. You know, you mentioned, you know, new building tools and materials, and then the battery space as well, right? I mean, I think that there's a lot of kind of new, and I think just investing across those areas, we've started one thing that's precipitated out of that is this idea that, you know, what about materials and looking at history around materials. You know, you mentioned Bell Laboratories and AT&T. I mean, back 20 years ago, there were these big materials labs that I think, you know, whether you look here in the US or places like Australia, the UK, you know, that really, I think that whole strategy has really been diluted, you know. And I think when you think about these new industries and these themes and all the technologies and building materials that need to go into to making that a reality, it does rely a lot on that material space. So that is something that we're kind of pulling out of that and saying, you know, can we build a capability, and is there enough here? And so that's something that we're very much looking at and researching now at the moment.
Thank you. It would seem to me that the critical future is materials that are multipliers. Rare earths multiply the efficiency of turbines 5 to 10-fold. Graphene can multiply, if Samsung is right, and it can multiply the life of a battery 10-fold. These multipliers are going to become increasingly important. Thank you. And I defer to John Sibley Butler, who I hope will forgive me, and I hope the public will forgive me for interjecting and keeping his genius from them.
well, let me just say this. First of all, before I comment on that comment, I think that technologies now are combining. You know, they cannot be seen in one type of area. The combination of technologies are creating different kinds of companies. And so when we look at technologies, we got to ask a question: how can they combine with other technologies that will allow us to move forward? So no longer do we look at technologies as in one kind of environment, but the combination of technologies are very, very interesting today. And Llewelyn, for those companies who don't change, that's why they're gone. That's why Kodak is gone, right? That's why Sears and Roebuck is gone. If the management are not creative, then they disappear. And we have seen that from TWA to Braniff Airlines to Kodak. If you're not going to be creative, as Schumpeter said, the great Austrian sociology economist, there's something called creative destruction, and you will be destroyed if you don't change.
I wanted, John, to ask you a question. As somebody who's keen on air taxis, as I am, going back to the large versus the startup, would you believe that the air taxi, which is coming, the electric air taxi, that it would be better off being appended to an airline or under its own freestanding jurisdiction?
Well, here what's happening in Austin is that they're getting the airways for Uber Airways, and that is, I think that their models, their business models will be different. One is going to be interstate and intercity. But I think that the Uber model, where we have you flying around like a bumblebee, can you imagine that, is their own business model. They will be independent. Now, whether or not Southwest Airlines would like to purchase them is another deal, but they will be out of their business model. But it is coming. Uber in the air is coming, and it's coming soon, and it will probably start in Austin, Texas.
It's actually, I believe, already started in the Gulf.
Dubai.
I hate to mention that any part of the world has in any way overhung the glories and the wonder of Austin, Texas.
Well, they stole it from Austin if it started there.
So Gabriel, real quick in closing, when you look at when you look at the what's going on in Australia, which is to me the most phenomenal example in modern history of a small population country that plays at the global level like no other country, on winning Olympic medals, on innovation, on wealth creation. I mean, it's only, less than 30 million people, and they play with anybody. So when you look at that country and what it is, to me, is a symbol of prosperity, of excellence in 20 million people, 30 million people in an island. And you compare that to the US and what's going on with the superpower of the planet. What do you think? I mean, pretty similar, different. What do you think?
Look, I think it's very different. I think the successes and failures of a country really built on the history, the culture, and then the people at the forefront, right? And all those things kind of build up to create some outcomes. And so, it's slightly different cultures and people, and that then influences behaviors, right? And so I think, with Australia, they've got a really rich resource base, intelligent people, to your point, innovation, wealth creation, and the finance and fintech side. I mean, they've done a really good job of that historically. And I think on the US side, equally, I mean, this is a capitalist country, I mean, we have our successes as well. I think something that is akin to Llewelyn's point around companies getting too big, and that focus being diluted because it's just so many people that now, interestingly enough, like living in Australia for so long and then helping companies come to the US and land and expand, that Australian mindset is, oh, well, we'll go into the US and we'll land there and we'll have we'll market to the US population. And part of the success of that is coaching some of these founders to really change the way they look at the US. And the US is really, depending on what market you're in, it could be viewed as 5 different countries. It's
Sure.
5 different marketing plans, and that speaks to the geographical, cultural differences again of the people, and then that influencing again the intents and the behaviors and things. So I think it's hard to do an apples to apples comparison when things are that different.
Yeah. No, I appreciate your feedback, and I respect the notion that you have been successful in both, and I look forward to our continued journey. Thank you for being here today, and I don't know if my colleagues have some parting comments.
It's been wonderful to share your ideas and to listen to your ideas. Keep doing great things, Gabriel.
Well, I'll call you, John.
Okay.
Hey, Gabriel, I thought it was terribly interesting. You are obviously a fascinating man in the right place at the right time, and I'm envious of that. Go to it. Or as the Australians might say, good on you.
Yeah, good on you. Now, look, I appreciate that.
He's a bobcat.
I appreciate that. I think, look, you guys here, I have a respect and admiration for all 3 of you for the different things that you've accomplished and kind of your backgrounds. And so absolute pleasure being here and talking to you guys.
You bet.
Johnny, take us away.
I will take us away. Are we going? Are we going? Photographs and memories. Christmas cards you sent to me. All that I have are these to remember you. Memories that come at night. They take me to an early time, back to a happier day when I call you mine.
Excellent. Thank you, Johnny. Thank you. Woo. Thank you, Gabriel.